So Justin, as you know, at Fedgroup, we're rolling up the red tape at the moment now on financial services. It's really good to have a conversation with you here today. A bit of focus is very much around savings. I'd love to get a bit more insight from you, specifically around alternative investments. Is there anything specific that you can tell us around what actually alternative investments are?
Yeah, thanks, Paul. I think alts is such a difficult topic because everyone goes like, what is alternatives? Like, where do we draw the line? I mean, if you look at the strict definition, you'd go and say that stocks and bonds are traditional investments and everything outside of that is alts. Most people almost have a heart attack when you hear that because you're going to look at property. Property feels like a traditional investment and it definitely forms part of that. And I think as and when people get more knowledge and as we digress or go through time, more and more investments become traditional investments. So, I mean, everyone keeps going like, what is crypto? And is crypto a traditional investment? Is it not? Because if you look at it, at the end of the day, it's theoretically buying a share to some degree. And then you can go down the line of saying it's blockchain, that kind of thing, which is completely alts. If we stick to the strict definition, the likes of hedge funds, private equity, that kind of thing, or your alternative investments, or maybe something that isn't listed. I would say that would be your alternative investments.
There have been some important changes recently in some of the regulatory frameworks around what funds can allocate and what funding they can allocate to alternatives and private equity, which I think is exciting because it's an area where it's always been almost that reserved for that high risk part of your portfolio. But I think we know that it's a part of, especially in South Africa, it's the funding that goes towards this asset class is so important for things like job creation, advancing our economy, getting our GDP going, aspects of our economy like that. So, I mean, are they always high risk?
So I'd go with no off the bat, and the only reason why I would say that is because of the common misconception is like, because it's private, because it's alternatives, it must be risky. I think you can use the same traditional structures that anyone uses to structure a deal on a structured finance perspective to do the same thing with alts to almost de-risk it. I think at the same time, you've got to look at what are you trying to achieve. So if it's returns to proper returns, like you've said, I think that's a massive thing that we look at. But at the same time, what we've also started to see, which you touched on, is it only reserved for the high net worths? I think not. I think if you look at Fedgroup's done the exact same thing on the impact farming. You can access almost private equity type products at a very easy, accessible level. And I think globally, that's definitely a trend that we're seeing where you don't only need to be an extremely wealthy individual to access things like that. As well as the fact that, with pension funds and that, there's a percentage allocated to that. So it's a lot more accessible as time moves on.
Absolutely. I'm often asked in my role, what specific asset classes are most important and what make up a balanced portfolio or certain risk-adjusted portfolios. I'm certainly seeing a huge shift towards alternatives that make up your sort of non-equity portfolio. So if you look at a balanced portfolio in general, a fund manager would generally be allocating around 60% of that portfolio towards the equity holdings and the balance of the 40 towards asset classes like property, cash or cash equivalents, alternatives, private equity, etc. So I do see a big shift in those allocations now towards these private equity type of investments. I just think because of all the good spin-offs around the sector, I think it's going to be more and more amplified around a key sector of the economy to support through asset allocation, through funding.
To add to that, I think if we look at, like everyone says, private equity, there's also private debt. And I think that forms a massive part of the latest stats that allocate towards your alternatives. So I think at the same time, like we've said, individuals with a bit of cash are starting to look for higher returns. And where they understand the financial industry, they can plug themselves in as private debt and get a higher return, but still very close to the same risk that they were getting prior to that.
That's an important comment you made, because if you look at inflation, where we are at this point in time now, and where potentially it's being forecast, people are going to have to search for more yield. Investors are going to have to look for higher yielding investments in order to achieve inflation beating returns. That's a key one. I think what's quite important is picking the right manager. Not all alternative investment managers are made equal, and it generally takes a higher level of skill and complexity to run alternative investments or alternative fund strategies. And I think picking the right manager is going to be very, very key. And I think that's something we're very proud about at Fedgroup, is around our niche of private equity, or our niche of alternatives in the impact farming space and property mezzanine space, where we believe we've got entrenched long-term competencies in looking after those type of assets on behalf of our investors.
Impact investing is definitely an alternative style of investing. We've been doing it for 5 years, so I think that kind of experience is difficult to find. If you look across South Africa, there's no one really doing what we're doing, especially on the scale that we're doing it. So those skills that Fedgroup has pretty much paid the school fees on, we should be using that to diversify into other alternative types of investments. Like you said, potentially the likes of private equity, private debt. I think where you could say that the risk goes a lot higher is your hedge funds and stuff like that.
Sure.
But again, I think we've got the expertise to mitigate like a higher risk, especially because we've got the asset managers and all those kinds of things involved.
Absolutely. So just listen, you've got a lot less grey hair than someone like I have. You're a young guy. You're well skilled in your field. What are the younger investors wanting? What sort of behaviours are they exhibiting around their investment choices they're making?
I definitely think there's a massive change in terms of what the younger investor wants versus your older crowd of people. I think there's a big shift in terms of investing in mining versus investing in a beehive type of thing. And what does it do to the environment? I do believe that the younger investors got a bigger interest in the impact that it has on the environment and those shares that you're looking at. Along with the fact that I think younger individuals are starting to look at investing as a whole, or even savings as a whole, a lot sooner than older generations. I think a lot of the times your younger generations, they hit their 20s and they start to look at quite seriously what are they investing in, what do they want to do, and a big part of it is definitely the ESG impact, green feel to it, but also the idea of pretty much educating themselves before going to a financial advisor. So I think there's a big role in terms of individuals going to get their own knowledge, especially because knowledge is so accessible to us now, and then looking into the ideas of how do we like make alternatives more accessible to younger people, to individuals that aren't just ultra high net worth clients. And that's where I think their interests are. I do believe that there's a lot less, I think bonds, I don't want to say bonds have fallen away, but there's a lot less emphasis on bonds. There's still stocks and stuff, but it's not as big. They're looking for the edgy stuff, and that's where you see things like crypto and more tech companies coming in as well.
It's almost a trend where we're seeing, so the savings culture is still very strong, if not potentially even stronger than it was when I was in my 20s, potentially. But it's what the younger investors are looking for are investment vehicles or options that provide a little bit more sort of tangibility, potentially. They like to feel things. Maybe some of the traditional investment vehicles are a little bit intangible. However, it's quite an interesting trend as well, in the sense that you have that, and I'm seeing that as well now with the young investors. Then you jump over to the cryptos and blockchains, which is totally intangible, but it's got this huge support around it. So it is quite a tough one, but what I'm hearing is that the savings culture is strong, and if anything, I suppose COVID has taught us that saving is key, and having accessible funding and savings when they don't term it a black swan event now, where these unexpected events occur in the financial services industry. Yeah.
Exactly like you said, and that's why I gave you a little bit of a smile, is it's quite weird. The younger investors definitely looking for something more tangible. And I don't want to say that they've got control, but they've almost got a little bit more understanding of how does that work. And I think that's your impact side of things. But exactly like you said, on the extreme side of things, they've got like DeFi, your decentralized finance, and what does that look like? And they like the idea of that. You almost want to put it down to the fact that there's regulation that they don't enjoy. And that's what those two different areas have in common, is there's a lot less regulation. But to your point, I think with regards to savings, it's quite interesting. I think maybe my view is a little bit skewed in terms of savings, because I would almost like to say, although a large majority of people probably lost their jobs and had to pay cuts and those kinds of things during COVID, but I think a lot of people realized how important savings was, as well as the fact that like we should be saving during those periods. So where we were going nowhere, where we had hard lockdowns, whatever you were spending on fuel should have been saved. And I think from that perspective, there was a big push to say, hey, savings is important, regardless of your age, regardless of how much money you make or what you're investing in. I think we need to save. At the end of the day, that's what we need, especially for things like COVID. What happens if you lose your job? I mean, perfect example is, like, as far as I know, South Africa is not a big savings nation, but a lot of the times, what happens if you get a flat tire? What happens if you have to buy a new tire on your car or something like that? Where does that money come from? And even interest rates, I think that's maybe one thing where I think COVID has skewed our savings ability, is everyone said, oh cool, let me buy a house while interest rates are low. And in the last 6 months, we've seen that interest rates have ticked up quite a bit. And what does that do to your current cash flow that you've got in your bank account?
But when we talk about balanced portfolios, or a balanced portfolio, it's almost along the lines of thinking about a diet, having a balanced diet. It all starts, actually, it emanates from you don't just arrive at having a balanced portfolio.
Sure.
It's a result of a process that you would work through in assessing one's risk, one's tolerance for risk, and one's ability to take risk. Those two very important factors. And then also importantly, planning for future liability events, what I call asset liability matching. So if you just take that analogy around a diet, a balanced diet is important. And we think about concepts of everything in moderation, etc., etc. But if you just directly relate it to that, now, not everyone has the same ability to cope with certain diets, and also have people with different tolerances to certain balanced diets. But in general, if you think about a balanced portfolio, as we said earlier, that is a portfolio that generally, very high level, has a 60% weighting towards your equity or stock market and a 40% weighting to alternative investment asset classes such as private equity, alternatives at the core, cash, bonds, property, etc. The risk process that you would run through will determine whether a balanced portfolio is suited for what you're trying to achieve. When you talk about that, you're talking very much around your strategic goals around investing. What a balanced portfolio does is generally smooth the journey. Okay? It doesn't totally obliterate any big dips in your portfolio, losing a bit of money or being below the market and above the market. Just like a balanced diet. A balanced diet is one way to get to your weight goal or your health goal or your BMI goal over a period in time. It's not saying that having a tactical strategy in investing in certain sectors of the economy or certain sectors or certain asset classes at a point in time tactically isn't right. So, such as all these interesting diets, if you look at all the different diets that are available and have prescription at the moment now, they are there, and people will prescribe to them at a certain point in time now to achieve a certain short-term goal. But over the long term, a balanced portfolio smooths the journey. So you can go into a specific diet, for instance, and get a massive weight loss or massive health benefits in a short period in time now. The sustainability of that decision is where you need to decide, is that for me, isn't that for me? So generally, the risk appetite and your tolerance to take risk or your ability to take risk determine whether a balanced portfolio over the long term is right, or if you need to employ some tactical asset allocations or tactical portfolio allocations now to achieve your investment goals.
Yeah, Paul, so one of the questions that I wanted to ask is your view on, like, what's the best approach? I mean, and that's a very difficult question. What's the best approach to creating your investment portfolio? There's equities, there's stocks, there's bonds, and then the likes of property you touched on, potentially to raise debt. Yeah, pretty much what is your view there? How do we get into that approach? And maybe let's look at the idea of like a very low LSM versus a decent LSM, the middle LSM almost.
I think the important aspect in approach is, first of all, to reiterate that any amount of investment and saving is key. So whatever you can, you need to save. A crucial factor that you can never ignore in building a portfolio and building your investment strategy is your need for liquidity. Simple as that. So, everyone has different liquidity requirements now, and that is a massive variable in determining, and actually it's almost your elimination criteria. So what is not on the table for me to even save or invest my money in is your ability for liquidity or need for liquidity. Now, ultimately, true saving is longer term, and therefore your liquidity should be then hinged around longer term requirements around needing that money now. But short term liquidity has become more and more a trend at the moment now. People wanting a lot more, investors wanting a lot more availability and knowing they can access their savings in the event of, God forbid, events in life happen, or just
like
generally, you're quite right, like COVID, exactly. And that, I think, has altered the behavior a bit. What's quite important as well is when building an investment portfolio is in line with your risk appetite, is deciding on variable returns and variable growth in your portfolio versus fixed returns. So what I've seen and what's becoming more and more an important addition to your investment portfolio and building it is building in pockets or buckets, as I call it now, of investments and savings where the return you are earning is fixed. So you are ultimately, in that case, you are handing over the risk in that way to the financial organization you're dealing with, like Fedgroup, in return for a fixed return. Now, often that fixed return can be incredibly competitive. If you take, for example, Fedgroup's secured investment, if you take the last 5 years and compare the return on that investment, which was fixed, compared to the JSE Aussie 40 or a general local passive equity fund now, it's, if not outperformed or been on par, and you've taken out all the risk and the sleepless nights out of that investment journey that you've been on for the last 5 years now. So it's not to say it needs to be 100% of your portfolio, but that, again, it is an important aspect around trends that we're seeing around more and more investors wanting to hard code growth, so that my 100 Rand today is definitely worth 120 Rand in 5 years' time, for example, now, as opposed to it might be worth 180 Rand or it might be worth 80 Rand now. So there's a far bigger balance happening there. Because as you know, your biggest growth driver over the last 100 years has been investment in your typical equities or stocks, which is ultimately investing in the underlying, which are companies. You're investing in the companies and in the hope and the trust and the belief that those companies will earn more profits, will get bigger, and become more and more successful, which then ultimately drives the share price and drives the growth in your investments. The accessibility, if you are an investor and you want to save, so your willingness is there. There are so many wonderful savings options available to you now that come at such low levels of entry. As small as 100 Rand. If I use, for example, our impact farming platform now, for 100 Rand, you can purchase a moringa bush. That's a small amount. It's got long-term savings potential, incredibly good yields on that investment. Now, it's got all the benefits of doing good, saving water, got great ESG pros to it now, and it's as small as 100 Rand. Now, I know that 100 Rand can be a lot of money to the majority of South Africans now, but it's certainly a decision someone makes, and it's very, very commendable for anyone that chooses to actually then put money away for a rainy day.
100%, Paul. I think what you've said there is amazing, and I think to your point, we all need to look at when do we start investing, and the idea of 100 Rand into moringa is an easy decision. You're not sitting there going, "Whew, I really need 5,000 Rand for the rest of this month. I can't put that into my investments." What's quite nice is obviously the idea of 100 Rand is easily put away. For, I would say, a decent amount of the population. And that then leads us into the fact that you're starting your savings journey. And I think as those returns come, I think it almost becomes like a bug. You start to realize, absolutely, this is exciting, this is really awesome.
And I think on that journey, Justin, if you what I mentioned before around, if you're a young investor and if you are an established investor, to partner and to not go it alone, go it alone. Don't go it alone. Have someone there, a professional, do it with you. And don't get stuck into the, oh gosh, I've only got this amount of money to invest. I'm not worthy of speaking to a professional. That's absolute nonsense now. Because in those times when you have been diligent and you've saved, and there are times where you feel the need, you may need to access your savings, you've got someone to talk to that can, in many cases, counsel you through, is it the right time? Yes. No, and if you're dealing with the right professional, they will take a measured approach. And if you need the funds for emergencies, the funds are available. The savings are there. If you don't, they will work with you on alternative strategies in your financial world to potentially meet some financial requirements without having to access the savings. So that's why it's so important to work with a professional, work with a financial advisor, work with your financial services provider that you've chosen to place your hard-earned money with.